Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this Monday Minute Live Chat hosted by the Canadian Leadership Congress. And today we're talking about how asset owners can prepare for a bumpy road ahead as market conditions get tougher. And to talk about it all, I'm here with Johanna Kyrklund, Chief Investment Officer with Schroders. Welcome, Johanna.
Hello.
Nice to be back. Okay, so my first question, look, equity markets have been really powering ahead over the last couple of years, but lately you've been urging asset owners to consider pulling back a little from equities. Why is that?
Well, I think, ultimately we're still positive on equities, but I think the easy money has been made. Over the last 12 months, we had the reopening trade as we all digested the news of the vaccines, and there was some return to normality. So as I said, the easy gains have been made. I think looking ahead to the next 12 months, we still see opportunities, but we are going to be facing, the withdrawal of liquidity from central banks and also potentially peaking in earnings momentum. So that's why I'm saying we need to start maybe having a little bit of caution towards equities as we look into 2022.
Okay, well, look, post-pandemic, we were supposed to see a huge surge in demand as people went back to normal, but it's not really happening. Why do you think that is?
Well, ultimately, we still live in a highly disrupted environment. So I think that, and this is why you're seeing also these bottlenecks, is because ultimately our demand is popping up in places that we're not used to seeing it, like in the case of the UK, holidays in Cornwall, for example. So I think one of the challenges people face is obviously on travel. Travel is still highly disrupted, very different rules depending on what country you want to go to. So I think that's preventing the return to normality on that front. And even actually when it comes to the service sector in domestic economies, one of the challenges we're seeing is rising prices. There's a shortage of labor, things are quite expensive. So I think that's also preventing people from getting back to normal.
Right. So as a CIO, what's keeping you up at night right now?
A number of things. I think the first thing is something that probably has worried many of us for a while, is that quantitative easing has essentially borrowed returns from the future. And when we do our sort of efficient frontier analysis over the next 10 years, returns look quite muted, partly because of the evaporation of yield from the bond markets and the credit markets. So I think there is a bit of a return challenge here. I've compared it to that film called Speed from the 1990s. I don't know if you remember it, but you're essentially forced to drive at 50 miles per hour because the cost of moving defensive is punitive with rates at zero. So that's one of the challenges I worry about, is that we're having to run more risks than we would normally do. There's government bonds aren't diversifying as much, and ultimately there's less return potential from markets.
Right, and I want to pick up on that a little bit. The European Central Bank has been pretty clear in its messaging on inflation and when rates will rise, but the Fed has sort of been a bit different in its commentary, and some are worried that's moving markets a bit. What are your thoughts on that?
We do expect the Fed to be in play at the end of next year. So obviously now there's talk of tapering, but we also expect rates to start rising at the end of 2022, because as we move into next year, the output gap will be closing. And we actually think that's healthy. We would expect the central banks to react to a closure of the output gap, to tight labor market conditions. So I think ultimately the course that's being followed by the Fed, I think, is appropriate. They're taking their time, but ultimately they will react to tighter labor markets.
Yeah, and one of the things that has investors quite concerned, again, is around this issue of inflation. And, there are some out there talking about sort of a return to the 70s, of course, when inflation was running very high and growth was quite slow. Are we headed in that direction again?
I don't think we're necessarily going to the 1970s. That was a very extreme environment. But certainly it does feel like the risks are skewed in a stagflationary direction. We do expect inflation to be somewhat higher over the next few years because we think the pendulum is swinging towards labor. There's political reasons. People are worried about income inequality. There is some pressure towards deglobalization. I think all of these things will lead to higher wages and ultimately to higher inflation. But no, not back to the 70s. Stagflationary because at the same time as all this is going on the labor market front, we also have an environment where demographically there's less demand, but also the focus on environmental factors, I think, will also lead to slightly slower growth because ultimately caring about the environment ultimately leads to people consuming less rather than more. So all in all, I'd say there is a risk of a stagflationary environment.
Okay, so you've raised questions about the role of bonds, and I think they're really important questions, especially given everything we've been talking about today. What should the role of bonds be for asset owners, and what are the alternatives?
I think that, the role of government bonds as a positive carry hedge in the portfolio, I think to some extent we need to get to the acceptance phase and accept that there isn't an alternative to that. This positive carry hedge with a negative correlation with the market. So to some extent, we're going to have to just focus on diversifying return sources across a range of asset classes and accepting some positive correlation with equities. So I don't think government bonds can be easily replaced. I don't think hedge fund strategies are necessarily the answer because they're a lot less reliable, hard to do at scale, et cetera, et cetera. Maybe we want to discuss another day. So what do we do? I think that there is still a role for bonds as a source of yield in the portfolio. In its zero rate environment, earning a yield is very important. And so in the case of bonds specifically, I would advocate moving up the risk curve in bonds, accepting some positive correlation with equities, just to get that carry, that yield into your portfolio.
Yeah, and I think that's really important. A lot of our delegates at our events, et cetera, all of the plan sponsors we talk to here in Canada, some of them are really mature plans, and they're really really in need of cash flow, right, to pay out pensions. They have a large number of pensioners on the books, and what are their alternatives right now?
Well, exactly. I think ultimately we still need those lower volatility assets. And so, as I said, I think there is still a role for for fixed income, for credit in the portfolio. And I think the other thing we need to remember is that at the same time as we're facing inflation risks, we've also seen extreme pressure on government finances. So I think the central banks will be doing everything they can to suppress the rising yields. And so that ultimately leads to an environment of potentially low returns from bonds, but you can still earn that coupon, earn the carry. I think that's very important.
Yeah, we've talked a lot, you and I, in our discussions about ESG and sustainable investing. And, is this huge shift in the markets and the impact of the COVID-19 pandemic, is it going to shift up priorities for asset owners and put the focus more on return generating investments rather than, say, sustainability? Or is that even a fair comparison?
I think it will vary probably by region globally. I mean, I think I could certainly give the European perspective. It's interesting that the pandemic actually accelerated the focus on the environment in Europe. It allowed the European authorities, possibly because they don't have the Brits in the middle of it all also, but they've allowed them to coalesce around a common mission, which is ultimately to move to a more sustainable future. And essentially in the depths of the pandemic, they came up with a Green New Deal. I don't think that's going anywhere. I think that is fundamental now to the direction of travel for European policy. So certainly in Europe, I think the emphasis on climate is not going away. I think it's also true of we've seen other major economies focus on this issue. So I don't think we'll have the luxury of thinking about the climate or generating return. We'll have to think about ways in which we, as asset owners or asset managers, can hopefully generate return by benefiting from the shift in the policy environment. Benefiting from energy transition. I think there is money to be made from these opportunities, finding those companies that maybe are moving in the right direction that will eventually be rewarded by the market. So I guess what I'm trying to say is investments got more complex. We're thinking about risk and return, and we have to think about sustainability within that as well. But I think that is an opportunity for those who are willing to do the work and the analysis.
Yeah, and how easy or hard is it to identify those opportunities and to really tap into this great energy transition that we're looking at? Is that getting more challenging? Is the capacity there?
I think that if you just take a fairly passive approach to all of this and buy the obvious companies, the risk is you'll be exposed to an ESG bubble. But I think if you take an active approach, and we at Schroders have invested very heavily in our proprietary tools so that we can do this analysis stock by stock, actually can uncover opportunities, and you can work with companies to move in the right direction. But ultimately, if you think about it today, and I think it's interesting going into COP26, there's a big gap between what the governments have committed to and where the corporate sector is. And I suspect that gap will be closed in some instances through some form of changing the price of carbon, be it carbon taxes, which then might lead to carbon tariffs. Again, the reaction will vary jurisdiction by jurisdiction. But ultimately, there's a gap there between what governments are committed to and where the corporate sector is. And I think that part of that will be dealt with through regulation.
Yeah, I mean, are you hopeful that we can bridge that gap within the time frame that's been proposed?
I don't know if the time frame is realistic. We'll have to see. I guess what the pandemic has shown us is what we can do as a human race when faced with a challenge. You know, the fact we're able to find vaccines so quickly was really remarkable. I think that ultimately it's about an ecosystem shifting. So I think that through the whole chain, you know, from the governments to the asset managers to the companies, the asset owners, we're all pushing in that direction now. And I think that ultimately what's interesting about pandemics or any major crisis, think about the First World War, is it does fundamentally change behavior and people's perspectives. So although, of course, a focus on climate is completely unrelated to the pandemic, it did allow us to run quite an interesting experiment, which is basically to force us all to be at home for a while and not fly, for example. I think the cards have been reshuffled. So I think that we are in for a profound time of disruptive change for years to come now, partly accelerated by the pandemic.
So what do you see happening to asset prices over the coming months, given some of the challenges we've been talking about today?
As I said earlier, the easy money has been made in terms of that rapid growth improvement coming out of the pandemic. But I still see a window of opportunity for risk assets because ultimately rates are still low and earnings are still high. So still opportunities to make money over the next, say, 6 months, 6 to 9 months. I think eventually, as we head into the end of 2022, people will be focusing on the prospect of tighter central bank policy. Earnings momentum will be peaking. And I think then potentially we'll be facing more risks from an asset price perspective. So a little bit more to go for, but I think it's time to maybe start preparing for a more difficult environment. Because as we all know, it takes a while to make, ideally you want to prepare your plans a year and a half in advance. At least that's what I believe.
Yeah, you know, is there a difference in sort of volatility? Is that going to play out over different geographies, for example? You know, looking at Asia or looking at Europe versus North America?
I think in some sense it's interesting because I think central banks are essentially suppressing volatility because they're suppressing volume. So without that rate volatility, it's hard to get major volatility in the market. But I think it's more that it'll become a challenge for equities to really make headway if we see a rise in cash rates, if we see a peaking in earnings momentum, if people become more focused on the stagflationary consequences of what's going on at the moment. So I don't see it as volatility as such. I see it more as less reliable returns as we head into a more mature phase of the cycle at the end of 2022.
Okay, so you've talked about stagflation. A lot of the talk right now is about inflation, but I really think that stagflation point is really on the mark. In your view, how should asset owners be positioning themselves to get around that?
I think the first thing is, certainly in our portfolios, you know, for a decade we didn't own commodities. This year we've owned them. I think they are an interesting diversifying strategy. So I think it's helpful to own commodities in the portfolio in a way that I didn't for many years when I thought we were very much in a deflationary regime. I think also still a role for government bonds, but as I said, for bonds, you have to move up the risk curve into credit, earn that extra yield, accept some positive correlation. And that means you also have to cast your net more widely and think about other alternative assets that could help you to diversify the portfolio in the absence of the diversifying benefit of government bonds. I think the final point is to really think about the equities we own. If you look at previous stagflationary episodes, you often end up with a two-tier market where those equities, those companies that can sustain their pricing power are winners. And you end up with a narrower market performance. So I think being in the right parts of the equity market will be absolutely crucial. We've been emphasizing, for example, certain themes where we think that the structural factors are so strong that we think that pricing can be sustained. Like, for example, disruption in technology, energy transition, sustainable food and water. We think these are long-term trends where pricing power might be able to be sustained. But I think ultimately in equities, we need to be positioned for a narrower market environment, not broad market performance. So be careful think through what kind of equities you own, I would say.
Yeah. It's a really difficult time for asset owners, and although their time horizon tends to be very long, it's been a rough road with COVID, et cetera, and putting pressure on organizations. What advice do you have for asset owners as a fellow leader in getting ready to ride out this tougher market environment?
I mean, in some sense, the pandemic gave us a good rehearsal for tougher markets. The good news is that from a market perspective, although at a human level, it was obviously distressing, from a market perspective, we came out of the woods quite quickly. But in some sense, it was a useful reminder that sometimes the unimaginable can happen. And I think that in terms of, so it provides some important lessons. What helped us to navigate the pandemic? First of all, we've always done extensive scenario analysis. I think this idea that you can invest on a central scenario, I don't think that works. I think you always need to think about what are the risk scenarios and how are those probabilities, the probabilities of risk scenarios changing? Because even if a risk scenario isn't your central scenario, a shift in its probability will affect market pricing. This was a lesson I learned in the financial crisis in 2008, where, the mother of all credit crunches was never my central scenario. Of course, that ended up being what happened. But my point is a shift in that probability would have freed you up to maybe position more defensively more quickly. So I think scenario analysis is really important. I think it's also important to think about your decision-making structure. Again, when you don't have to make very difficult decisions, it's quite easy somehow to muddle through. But I think it's really important to have the highest level of accountability and maybe a thought about, it might be that you can go for more consensus decisions in a more benign environment. If things get tough, sometimes as a leader, you have to step in and make decisions quickly. So I think thinking through what's your governance structure, how are you organized, how flexible can you be is important. I think the final thing is also the importance of looking at a broad range of data. So if you think about it, for the last 20, 30, 40, 50 years, we've been focused on accounting data. And actually the reality today is that ESG data is going to be a lot more important in driving the relative performance of stocks. So that's an example of alternative data that you need to be focused on. And we're already seeing that traditional factors are not performing as well as they used to. On the other hand, things like carbon intensity as a factor, when we test it now, is showing a higher Sharpe ratio. So different kinds of data, different kinds of analysis. Again, with the pandemic, what that showed is we had to become epidemiological experts very quickly. Obviously, I couldn't do that, but the point was that we had an alternative data insights unit that allowed us to set up our analysis of that information very quickly. So thinking through what are your information sources, don't just rely on traditional accounting data, because again, we're in a highly disrupted environment. So those are just some ideas.
Yeah, no, that's excellent. I loved your comments on scenario analysis and particularly on the relevance of data and looking at different data points than we might traditionally look at. And I'm wondering, how hard or easy is that to do robust sort of 3D scenario analysis in such uncertain times and in such a disruptive environment? How do you go about doing that?
Obviously here we have huge amounts of resources to do it, but I think you can do it quite simply as well, in the sense that you don't have to come up with a highly quantitative process. But I think the critical insight is that the market can be driven by shifts in the probabilities of risk scenarios. So when extreme events happen, people's tendency is always, you have some people are always pessimistic, right? You always have the perma bears are pessimistic no matter what happens, right? And then the rest of us tend to fade the volatility. That's what we've learned to do over the last 20, 30 years. And the key thing is, if you think in scenario space as opposed to central scenario space, you think there's 2 or 3 or 4 things that could happen here, and you ascribe probabilities. I think it frees you up to understanding that some of these risks that might be a bit out there, that those probabilities are important. I'll give you one example. We had a scenario which was vaccines fail, which might have seemed like a very extreme scenario, but the reality is we got shades of that over the last year. What's become evident is that some variants have outrun the vaccine. And of course, there have been some major logistical challenges to people getting the vaccine in some countries. So actually having that sort of signpost out there, thinking through what if the vaccines fail, prepares you then for a less extreme scenario where maybe the efficacy of the vaccines is not what we expected for a range of reasons. I think the key thing is getting out of that central scenario mindset.
Yeah, no, that's excellent. I love it. It's sort of integrating that glass half full and glass half empty perspective, isn't it?
Yeah.
Excellent. Johanna, it's always wonderful speaking with you, and we always enjoy it and find your comments so insightful. And today that wraps our Monday Minute for the week. Don't forget to send us your questions, and we'll get right back to you with our speaker response. And in the meantime, thanks so much, Johanna, for joining us.
Thank you for inviting me.